Hello, and today in my video I'm going to give an introduction to financial markets. So how am I going to go about this? Well, we're going to look at the what, who, why and how of financial markets, right? So let's start with the what. What is a financial market? Well, a financial market is a marketplace. The name says it all. It's a marketplace, i.e. a place where buyers and sellers come together to trade in finance. Now, what do we mean by finance? I'm not going to give you any dictionary definition, but I'm going to give you a way of thinking of it. You have liquid cash on one side, and on the other side of the spectrum, you have physical goods like a pen or a book or something like that. So financial products are things which are a cross between the two. And so when we say that we have a financial market, it's a marketplace of these kind of strange goods. And by examples of those would include assets such as equities, bonds, stocks, currencies, derivatives. Because some of these things, it takes a lot of imagination to understand. So it's not, like it's something you can say like a physical thing, like a scissors or something like that. So a marketplace is basically a market which allows the trade of these things. Now, following from the recent financial crisis, we've become very much against financial markets. Now, the argument we put forward is that we need to eradicate these financial markets. But you ask any economist, left wing, right wing, no wing, just neutral, they will tell you it is most difficult to imagine, to perceive an economy of such development, of such growth without a financial market, because they add a lot to the economy. And that's why finance is also so central to economics and economic policy. So I'm going to give you 5 reasons now which I think sum up the need for financial markets within our economy. Yes, they need to be regulated. Yes, this, but we cannot completely get rid of them. Otherwise, literally, we won't have a proper economy. And I'll do a historical sort of timeline of the arrival of financial markets in one of my future videos. And that will kind of show you why they are so crucial to growth. So why should we have financial markets? Well, the first thing is that they allow savings to build up. Now, you might say that without financial markets, you could still save. However, there's 2 key problems. If we have a barter economy where you have commodities and you save those, now the problem is when you save commodities, there's always a large amount of uncertainty attached to it about what will the value of these commodities be, and also when is the right time to sell the commodity. There's lots of speculation, but you will never know for sure, when is the right time. So it's not clear, it's uncertain. We don't like that as economists. And on the other hand, if you save a pile of cash in your cupboard, wardrobe or something like that, that's also problematic, because firstly, if you save £10 and the next year you have the £10 still there, you have made no interest on it. So if you save in a financial institution like a bank, you get interest, which is great, which you won't get if you save at home. But B, also with inflation, that £10 is not worth what it was last year. At least with savings, that is kind of counteracted by the whole concept of having interest on your savings. The second reason why we should have financial markets is so that we can accumulate wealth. Now, this is linked to savings because you accumulate wealth, but it's also to do with attaining assets and making investments, and all these kinds of things are only possible if you have financial market. Investment would be much more costly had these financial institutions not been there. This I will talk about in more detail later. And also with assets like bonds, stocks, and there's so many people who have made a ton of money. You could put fake money on that side, ball bearings, and you can just invest your money in any share, and you can just see you can accumulate wealth over time. It's great. It makes people richer. The third thing is access to credit. Now, the biggest problem about commerce is that people need money to start their own businesses. And what financial markets do is they allow transfer for people who have a surplus of money to people who have a deficit and they need the money. They allow this access. And also financial markets, they they have the knowledge that these people need the money, and this is their history, and these people want to give them money, and this is the way they treat people they lend money to, and so they can match accordingly, and they know who are the good investments and lenders and who are not so good. The fourth thing is insurance. Insurance would not exist had financial institutions not existed. And that is because insurance is actually a financial product. Basically, you are lending your money to a financial institution that puts it away somewhere and makes some investment, generates money, so that say anything happens to you, they can make that larger sum that's probably worth more than all your little monthly or annual deposits that you make to an insurance company. But again, it's an intangible financial thing. It's cross between, like money on one side and physical products. So insurance could not exist. And the fifth thing is economic policy, growth, and increasing people's living standards. Everywhere around the world, we want to push growth, we want to stimulate growth, we want to increase living standards, and basically by accessing credit, by offering insurance, by accumulating wealth, by having a means by which great savings can be made, economic policy can be shaped around this, and we can enhance growth. And also financial institutions and financial markets, they're so intertwined with the whole monetary policy that, economic policy is usually centered around them, and it can have double impact. If we just use fiscal policy and we cut out the monetary rubbish, our economy is not going to grow fast, because fiscal policy has its limitations, monetary policy has its limitations, so we need to use a bit of two to get the best of both worlds, to help our economy. So that's the why and that's the what done. So what about who? Who are the players? Who is involved in a financial marketplace? Well, you have the lenders who have surplus amount of money. Then you have the borrowers who have a deficit. That's why they need the money. Then you have the actual market structures. So you might have the stock exchange, the bond market, the foreign exchange. All of these financial products like we were talking about, they don't exist in one market. There's several different marketplaces. So the market also is basically a player. And lastly, and I would argue most importantly, are the financial intermediaries. These are institutions such as banks, mutual funds, brokerage firms, things like that. And basically, these are the institutions which are solely assigned to bringing the lenders and bringing the borrowers together, because otherwise you would just rely on chance. Now, why are financial intermediaries so important? And what makes, now, banks are a type of financial intermediary because they take in deposits and they give loans. But what separates, your Lloyds or general, I can't even think, because all the banks now are so intertwined with investment banking, but the cooperative bank, I'm pretty sure that's like more clean and straightforward. What differentiates that straightforward kind of banking from this kind of financial institution and the other financial investment banking that exists? Why is it different? Oh, and why should we have it? Well, the biggest thing is when you're looking for access to credit, if you're looking for a mortgage, if you're looking for this, the reason why it was so easily available was because these banks were so intertwined with investment banking. It was there. But a general bank, which, let's think, hypothetically, did not do any of the investment side, financial side, just took in the deposits, gave out loans. Okay, we'll give you a mortgage. Okay, we'll help you with your car. You want a small, just a little business from your house? Fine. But what about the companies that want to do millions of pound project? What about if you want to start a business which requires tons and tons of investment? What happens then? The bank, even if the bank agrees to give you the loan, your interest will be so high just because the quantity of your loan is so high. So it's cheaper and actually more effective for you to go to an investment bank and say, I'm looking to borrow money, and in return I'll offer shares in my company or bonds or currency or whatever you're dealing with. So it's cheaper to pay like dividends rather than have to pay interest back on the loan. And it also, it makes sense sometimes. Just a lot of the times when you're dealing with the world we live in today, it makes more sense. So what have I talked about here? What are the other things that are important about financial intermediaries? Well, one of the great things is that they are the go-betweeners between borrowers and lenders. And why is this important? Because previously you would have relied on chance in order to meet your lender or to meet somebody you want to invest in. And chance, like, you can't rely on it. It's not an economic concept. And so say you decided, okay, fine, I'm going to go out there and I'm going to find some business I can invest in or a lender. That involves lots of information costs and transaction costs, because you need to make information that the person is right, they're not a problem, blah blah blah. Then the transaction costs, having a lawyer draw up a contract, having you made maybe as a venture capitalist or whatever the situation is. Those are the costs. So another benefit I wrote here is that it gets rid of the information and transaction costs. It makes assets more attractive. So what it does is, because what these investment banks do is they take risks upon themselves, because they do rely largely on the law of large numbers, that if 90% of the transactions are going smoothly and they've made a benefit of it, they can afford to take on the risky 10% and pay out for those few that go wrong. So and they can do this because they can make assets more attractive. One of the key ways they make assets attractive is by something called maturity transformation. So they take money from lenders, and lenders say, we want a high return in a short period of time, or at least some kind of return in a short period of time. They take that money and they say, cool, we'll do that. Then they say to the borrowers who want to take the loan, but they want to pay over a long time. So the word maturity is to do with time, that that the borrower will pay it over, say, 10 years, and he wants his money within 10 months. So they might pay him, and they keep this system going until he's covered up the cost. That's a risk, because that was a risk that the lender was supposed to take, but the bank's taking it instead, because, it's the mass thing. More of these happen, the less chance there are they go wrong, and the more people there are, the more demand there is. It makes assets more liquid. This I will talk about more later, but basically some of the investments, some of the borrowers who come, they come with assets. It comes with things which they're very hard to turn into cash or resell or things like that. So what they will do is that they will make the asset or whatever the borrower is offering more liquid, but then they might charge the lender a bit of extra money to make it. So that's also another way of making assets more attractive. And also, because they have such a wide portfolio of things they're doing, the risk is diversified. And in fact, if you, as somebody with surplus of money, said, I want to invest, you went through all the transaction costs, information costs yourself, you didn't go to a financial institution, at the end of the day, you're only going to be investing in one person, so you have your X amount of risk. Whereas if you went to a financial institution, then they might put a bit of your money here, a bit of your money there. They diversify the risks. So some things you have high returns, which is really important for people who have really large sums of money, because you don't want to put all your eggs in one basket. So that's my introduction to financial markets and financial intermediaries. I hope this is useful. See you soon.